Now, back by popular demand, it's the Lance Roberts Show.
And good morning. It is Friday Eve on this Thursday as we get ready to go for the day, 6:07, as we kind of get things underway this morning. Good news is futures are striking a little bit higher this morning. Of course, this is after yesterday's release of the Federal Open Market Committee. It's a long name for a short acronym, FOMC, which is what most people are used to. But that's basically the meetings of the Federal Reserve. And supposedly, this is just a release of the minutes, but don't be fooled. These are very much massaged minutes. You know, the stuff that actually happens, at the table when the Federal Reserve is sitting around talking about monetary policy and what they're going to do for the economy. That gets rewritten for public release. So it helps kind of abide by what the markets are expecting. Again, the Federal Reserve over the last several years has really been focused on keeping asset prices elevated to boost consumer confidence, to try to keep the economy going. Because again, we just kind of continue to kind of slug along here at 2.5% growth. Really hasn't been able to accelerate much more than that. So again, as we look at these Fed minutes yesterday, the interesting thing that came out, we're writing an article on this as well, which will be on the website later on today. Talking about what the Fed said, what the markets actually heard, and what you should know about. The Federal Reserve came out yesterday and said, well, when we were talking in our meeting last month, now these are the minutes from March, they said, well, we're a little bit worried about the global economy because, well, economic growth has been slowing down, and we've seen economic growth slow down in the fourth quarter of 2018, first quarter of 2019. We're concerned about the slowdown in economic growth, so we're just kind of be patient about raising rates. Now, a couple of other Fed members have already been out since that meeting in public talking about the need to potentially raise interest rates one more time this year, maybe another time next year. And this kind of complies with some of the recent economic data that we've seen. We've seen an uptick. We had just the strong employment report. And of course, CPI came out yesterday much stronger than expected, and not surprisingly because of the rise in oil prices, right? Oil prices up over $60 a barrel. It's been about a 42% increase from the recent lows. So when you have that type of input into the economy because of rising oil prices, hey, you're going to get price inflation, right? You're paying more at the pump. Other stuff that's based on, based on oil prices, electricity, et cetera, that all goes up in value. So that's causing more inflationary push. So again, you have to remember these minutes are from a month ago. And now we're looking at data since then, which is all showing a second quarter rebound, which, we said economically that's probably going to happen. We had, because of a weak fourth and first quarter, you're going to get a rebound in the second quarter. But nonetheless, all the market heard yesterday was that the Fed's not going to raise rates anymore. So this is kind of the same message that the markets have been hearing since the December 24th lows. But importantly, what they didn't hear, what they should have heard, is that the Fed is not done raising rates potentially. Now, they might be, right? If we continue to have weaker economic growth, then they're not going to raise rates anymore. But here's the bigger picture, is that the damage to the economy from hiking rates. So when you hike rates, you slow economic growth, right? That's why you hike rates. You're worried about inflation. You're worried about a runaway economy. So you start hiking rates. And that helps slow that down, right? It crimps consumer spending. People get less, they get fewer car loans, they get fewer mortgages. We've seen those numbers coming down. And so that's why you raise rates. So not surprisingly, when you raise rates, that's going to impact the economy. Well, it takes about 9 months from a rate hike to actually impact the economy. So a lot of the rate hikes that were done last year haven't even come through the economy yet. They won't show up until the second quarter, third quarter of this year. So the impact of higher rates, even though the Fed isn't going to raise rates anymore, the rate increases they've already done are still filtering through the economy. So again, the other side of this question is that yes, the Fed may be patient about raising rates at this point, but they didn't say they were going to lower rates. And more importantly, in history, whenever the Fed starts lowering interest rates, why do they do that? Well, they're worried about economic slowdowns, right? So the economy's getting too slow. We now need to lower rates to help stimulate buying and get people to go borrow more money. So we lower rates. When the Fed starts lowering rates, that's typically just before the onset of a recession, or coincident with a recession there too. So again, it's not what the Fed says. Now, the markets are still playing off of this currently, but it's not what the Fed says that's important. It's what they've already done. They haven't stopped raising rates yet. They might not raise them anymore, but they haven't stopped. They also haven't stopped reducing their balance sheet. They won't do that until September, but they're not reducing it either. So even though they may be stopping the tightening process, they're certainly not adding liquidity into the marketplace. So again, when we take a look at where the markets are trading, the markets are acting like quantitative easing is back and the Fed's going to lower interest rates by 0.5 point, so forth and so on. The Federal Reserve isn't going to start doing that until the economy and markets are under pressure. Now, there was a great comment yesterday made, and we actually had a great podcast yesterday with Teddy Valley. We're going to be releasing that podcast next week. I'm looking over at Brent Clanton, executive producer over here, nodding his head yes on Tuesday. We'll be releasing that interview with Teddy Valley because he is actually a portfolio manager and trader talking about their leading indicators that they track, which they track a whole variety of leading indicators all over the world, are all suggesting that we're going to have a pickup economically in the fourth quarter or first quarter of 2020. But in between now and then, we're going to have a pretty severe slowdown, which actually complies with a lot of the data that we're already seeing globally as well as domestically, that we continue to see slower growth. And again, talking about why that would be the case, because the interest rates that were done last year haven't filtered into the economy yet. Nonetheless, very quickly, markets are up though, with this continued trend here. We've been kind of consolidating here over the last few days. The markets want to make all-time highs. This is the goal right now of traders. They want to push the markets up from here. So again, a lot of positive bias to the market, a lot of momentum. But just remember one thing, bull markets are not born out of excess optimism. They're born out of pessimism, like we saw last December. So again, as we've talked about recently, look to take advantage of this rally here. Bring in some assets, bring in some profits, rebalance risk. Very likely this summer, we're going to see some weaker economic data that's going to continue to weigh on markets. And now that the Washington has now launched a trade war with China and the European Union, we could very well see an impact to profits, corporate profits domestically here as we move later into the summer. So keep a watch on that. Take a little bit of profit here. Watch what's going on. Again, read our newsletter. It's on our website. We update that, all of our allocation models every week in our newsletter and on our professional site, riapro.net. You'll find all of it there. We'll be right back after the break. More of the Lance Roberts Show right here at realinvestmentadvice.com.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.